Hey trader, are you a beginner and you really want to learn Forex but doesn't understand some of the basic terms used? Don't worry, I have got you covered. Let's break it down in simple terms. 1. Pips, meaning percentage in point. It is like measuring a distance. In Forex trading, pips are like the ticks on a ruler that measure the distance between two currency exchange rates. Each currency pair has its own pip value. But for most pairs, 1 pip is equal to 0.0001. So, if the Euro-USD pair moves from 1.1000 to 1.1001, that's a 1 pip movement. Pips help traders understand how much the exchange rate has moved and calculate their profits or losses. Imagine you're watching a race. Each time a runner takes a step forward, you count it. In Forex, those steps are like pips. They're the tiniest movements in currency exchange rates. For most currency pairs, 1 pip is like moving 1 step to the next number after the decimal point. Those small movements can add up to big changes in profits or losses when you're trading currencies. Okay, let's move on to the next item, spread. Picture going to a currency exchange booth at the airport. When you want to exchange your money, the rate they offer you for buying foreign currency is higher than the rate they'll pay you for selling it back. The difference between these two rates is called the spread. In Forex trading, the spread is the difference between the buying price and the selling price of a currency pair. Brokers make money by widening this spread slightly. So they'll sell a currency pair to you for a bit more than they'll buy it back for. The spread is usually measured in pips, and it's an important factor to consider because it affects your trading costs. Imagine you're at a lemonade stand. You want to buy lemonade from the seller, but here's the deal. When you buy a glass, you pay a little more than what the seller paid to make it, right? That extra money you pay is like the spread in Forex trading. Brokers make their money by keeping this difference. Just like the lemonade seller makes a profit by selling you lemonade at a higher price than they bought the ingredients for. Understanding the spread is important because it tells you how much it costs to trade. The wider the spread, the more it costs you to enter and exit trades. So, when you're trading Forex, it's smart to keep an eye on the spread to make sure it doesn't eat into your profits too much. The next thing I want to talk about is called leverage. Imagine you want to buy a house, but you don't have all the money up front. So, you borrow some money from the bank and put down a small portion of the house's value as a deposit. In Forex trading, leverage works similarly. It allows you to control a larger position with a smaller amount of money. For example, with a leverage of 100 to 1, you can control $100,000 worth of currency with just $1,000 in your trading account. While leverage can amplify your potential profits, it also magnifies your potential losses, so it's important to use it carefully. So, it's like having a powerful tool that you need to use carefully to avoid getting hurt. Always remember to manage your risk wisely when using leverage in Forex trading. The next thing I want to talk about is called margin. Continuing with the house buying analogy, margin is like the deposit you put down when you're using leverage to buy a house. It's a small portion of your total position size that you need to have in your trading account to open and maintain a position. Margin requirements vary depending on your broker and the leverage you're using. If your losses start eating into your margin, you might get a margin call from your broker, asking you to deposit more money into your account to cover the losses and keep your position open. Here's how it works. Let's say you want to trade $10,000 worth of currency. Instead of needing the full $10,000 in your account, your broker might only require you to have, let's say, $500 as margin. This $500 is just a small portion of the total position size, but it acts as a safety net to ensure you can cover any losses that might occur while you're in the trade. Now, if your losses start eating into your margin, your broker might give you a margin call. This is a warning that you need to deposit more money into your accounts to keep your position open and avoid getting kicked out of the trade. Understanding these basics will give you a solid foundation for navigating the Forex market and making informed trading decisions. Don't forget to subscribe. See you another time.